Well, happy Monday, everyone. Welcome to our Straddles and Strangles class today. I'm Connie Hill. Happy that you would join me here today, and we get together each and every Monday to talk about these. Actually, there's about 4 strategies in here, Straddles and Strangles, whether they're long or short. We had some really interesting outcomes in the trades we did last week, and I'm really excited to show you the lessons that we learned from what we did on those couple of trades. We have Oracle and Marvell. So we're going to start out showing you what happened there. If you're trading this along with me, and I hope you are, if you want to get really comfortable with these strategies, just do them in your paper money account. Then you can follow along. You see what happens with the particular announcements or whatever. And then it spurs questions, and it really helps you learn the strategy so much better than just kind of sitting back and watching me do it. All right. We are joined in the chat by good friend, a fellow coach, and fellow Cougar fan, Brent Moores. Happy that Brent is here. He's a great veteran of the markets. As you have questions, go ahead and type them in. I'm going to keep my eye on the chat, but Brent will also keep his eye on the chat and answer maybe some things that I can't quite get to. I do hope you're following both of us on our X accounts. I'm Connie Hill CS. Brent is Brent Moore CS. We'll post educational content, things we're noticing about the markets, news, things that might contribute to some decision making you might make. We like to kind of point some things out to you. So follow along. Let's go through our disclosures and get down to business. Options carry a high level of risk and are not suitable for all investors. What we talk about today is intended for education and informational purposes only. Don't consider it a recommendation. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. We'll be using the Paper Money software application. That's what you download to your computer. It's the most robust version of Thinkorswim. There's a little bit of a difference between it and the live account. The live account can and will assign early. Paper Money doesn't assign early. So if you're short some options, they're deep in the money and you don't get assigned in your Paper Money account, that is something that's not completely replicated, okay? We want you to be aware of that. Investing involves risk, including the risk of loss. Past performance is no guarantee of future results. All right. I do want to put in a little word here for upcoming workshops and market drive events. Last one for the year is going to be in Miami. What a great time to go to Miami. I went there in December one year. It's quite delightful as far as the weather goes. This is an advanced options workshop. 19th and 20th at the Marriott Hotel in Miami. If you're somebody that's maybe a little bit more advanced, and you're waiting for that advanced option strategy, hopefully you're taking advantage of that one, or you're close by and you can pop down there. Then we've got Dallas and Bellevue right at in January coming in the new year. So if you're close to those, can get there, enjoy those events, okay? They do fill up, and we have to close down registration sometimes on them, so get in early if you have any inkling that you might want to go. Ricebird said, glad Houston was fun. I think that was to Will. Somebody had a great time in Houston, which was our event over last Thursday and Friday. So hopefully those of you that went there, it was good for you as well. I know when I attend those events, people really enjoy them. I can't believe how incredibly nice we are to you. Well, of course we should be nice, but anyway, all right. Our agenda today, we're going to take a quick look at the markets, although for our strategies, we don't even really care too much what the markets are doing, but we'll take a quick look. I want to follow up on the trades that we did last week and set up a couple of new trades for this week that we're going to follow. So let's hop over to Thinkorswim. On our SPX, got that chart out. Looks like we're down a little bit today, maybe about 0.15%, which is not a huge deal, but market is down. Kind of getting into a little bit of a sideways pattern here more recently. So December typically is a pretty good as far as being a bullish month in the market. So we'll have to see. A lot of that can come through at the Santa Claus rally, which technically is not going to start until the day after Christmas. Okay, Santa has to already have come for the Christmas rally to start. So we'll see what happens there. The volatility index, let's take a quick look there. I know we got it. It's up a little bit here today, a little bit of a pop, but it's sitting there about 16.86. So it means a little volatility in the market, a little bit of concern, but not major concern, not major stresses, right? We're kind of, I think, sitting in a little bit of a holding pattern as we looked at that SPX. NASDAQ looks similar, but it hasn't been quite as strong as the SPX, but we have been getting kind of this sideways action on the NDX as well here. So what does that mean? It means, maybe there aren't a lot of really big moving stocks out there, and also not a lot of big concerns either. Now, we're kind of out of the earnings season. We're still going to talk about some stocks that have earnings, but the big season of it really is pretty much over. And that is one thing that has a tendency to send the market all over the place. And so we might just be in this little bit of a settling down period, which sometimes can be really helpful as a trader when you're like, oh, good, the market's not jumping everywhere for every little thing. All right, let's see here. Let's take a look at our trades we did last week. I'm going to remind you what we did. We're going to start out with, let's start out with the better of the two trades, okay? First one we're going to take a look at here was Oracle. Behemoth stock typically has some big moves in the markets. We talk a lot about the market maker move in this class. And the market maker move is how much premium do the options have priced into them that give us an expectation of movement? So typically they take the at the money strike price and add it together, and whatever that combines to, we're looking for a move either up or down of that move. It doesn't mean it's going to go there. Sometimes it does. Sometimes it goes beyond there. Sometimes it lays an egg, right, and doesn't do a whole lot. We never really know how it's going to turn out, but we know what the pricing is in there so that we can make some decisions. So on Oracle, we were looking at them last week in our class on the 8th. And Oracle, we did a short straddle. And on the short straddle, we sold the 220 strike price because that's pretty much where the stock was at. And this one, it had so much implied volatility priced into the options. That front week of the options was just incredibly juicy. I don't think I kept the percent that it was at the time I looked at it, but I think it was like 10+%. It was pretty juicy. So we went into this trade and said, fine, we'll sell a straddle. We sold it 220, brought in some nice premium, but we put on our order, we put in there that if we could get 25% of it at any time, we'd be happy campers and just jump out. If that happened before the earnings, great. I wasn't really planning on it to happen before earnings, but let me show you what did happen. Let me share that script with you. And anytime we share scripts, it's not guaranteed as to accuracy or time in. What it does on the screen is it puts a little notation here about what the market maker move is, sitting here in yellow, and then what the move is here. Now, right now, the news is out, so there's not like a big movement of space that it's showing that possibly the stock could go. It's really quite narrow right now. But let me share that script with you. And I just call it MMM on the chart, meaning market maker move on the chart. That's what I've called it. And I'm going to put it, let's see here. Let me put it in the chat for those of you that are here live. Those of you that are listening to this on the recording, I know lots of you do. When you have questions, let me know. Put them in the comments section. But also on here, you might want to just pause and write down this little URL starting with the exclamation point. Okay, that's really all that we need in there to give us the lines and show us what the market maker move is. So on Oracle, we're going to go to our position, our account statement here. I'm going to start with Oracle, and I started a little kind of spreadsheet for us that we could use to kind of track some of this information, okay? So I put in, we did a short strangle, and our entry price, what we brought in terms of premium, was really juicy, like I said. Of course, it's an expensive stock, so the options we would expect to be a little bit pricier as well. So on the put that we sold, we brought in 1270, which translated times 100 means we brought in $1,270 and $1,140 on the call. So it was quite, I'm going to say, I've been using the acronym JUICY. We'll just leave it at JUICY, okay? 1270. And I'm going to put it in this entry column. And actually, maybe I'll move this up because sometimes my picture goes there and it creates a problem for you. And then we're going to just say, well, what did we get on the Excel? Well, what happened? We got in a few days before they actually announced earnings. And the day before they announced the earnings, I want to show you one of our trades took us out. This one on December 10th. It went through. We got filled at 9:15. Initially, I was like, why did that trigger? Why did that trade go off? And then I remembered, oh yeah, and that one we said if we get 25%, we'll be happy campers and we'll just even jump out. And that's what happened. We got 25% on the 220 put. That left us with the call sitting out there by its lonesome. And you guys, these are speculative trades. We don't know which way it's going to go. We really don't. We just saw Juicy Premium and thought, let's take advantage of it. When the earnings came out, the market was negative on it. Okay. And so the next morning after the news came out, the stock really had a nice gap down and it dropped. Let's see, it dropped down here, but then it kind of rallied throughout the day, giving a positive candle on the day, closing higher than where it had gapped to on the open. When we looked at this the night before and we saw the market is acting negatively, I took off that 25, lock us in at 25%, because I thought we're going to get a lot more than 25% on this one, right? It's going to make that big of a move. And that's what happened. So the next morning when we saw what the price activity was going on here, we just went in and said, great, let's be done with our trade. Let's get out. Let's not extend this. And so we went in and we said, okay, great. I think at the time it was like for 10 cents, we got filled at 8 cents. So great. Then the net on that then was basically on that call, 1140, we captured most of it except for 8 cents. So we captured 1132 of this one. Okay, so let's fill in those numbers. So on the 1140, we bought it back for 8 cents. And on this one, the 1270, we had bought it back for 915. But I'm just going to let it do the math for us here, okay? I'm just going to say, let's see here, equals this plus this, our entry and our exit. Oops, let's do an entry there. So that's our 1132 there. And I'm just going to copy this down. So on this one, so on the call, we got out early. We netted about 355. How's that for a 2-day trade? Not too shabby, right? And because the Oracle call went our way, we got most of that. However, I want to stress to you, we didn't know what was going to happen. We didn't know that it was going to drop. We really were just hoping to maybe catch the implied volatility crush once it came out the next day. Regardless of the direction that it went, we wanted to try to capture some of that. So I want you to know the risk is real. We could have been assigned to buy some shares of the stock, and we could have possibly needed to deliver the stock to somebody else on the short calls. And so I want you to know it's just not sell the premium and it's all rosy. There can be some consequences that come through from the trades. This particular time, it didn't. Nothing was assigned to us. Paper money doesn't assign early, and nothing had moved deep in the money by that point anyway, by the time they announced. Okay. Lewis says, this has to expire out of the money. When we sell these, that's our goal. We collect this premium, and we want it to expire out of the money, but honestly, when we get the big mass chunk of it, we want to take it and run. I lock in that profit. Why would we sit there and wait until Friday for 8 cents? Like, what's the point? There's really not that big of a point. It's like, no, lock in your gain, move along. And that's what we decided to do. So like I said, this one was the one that turned out the better of our two trades. The other trade was Marvell. And like I said, I like the lessons we learned here. This one didn't turn out quite as fortuitous for us. This particular trade, we did a long strangle, okay? So we bought a 95 call and an 87 put, and the total there put us out $9.95. And it was expecting a pretty big move, and it did. It moved pretty big. And they announced, I think, on the 2nd, and then, of course, the market opened the next morning. So let's take a look at Marvell on the chart. This is where we got in. Then they announced, and then the next morning, big pop. So it did. It had a nice gap up, just like we were expecting it to do. It gapped up. It ran up a little bit. Then it came down a little bit. It started losing. We were having a red candle here, and it looked like it was just not moving that much. So what do? We went ahead. We closed out of the trade. We captured as much as we could. Let's go back to the timing on this. I want to go back to the monitor tab here. So the first thing in the morning that we could tell wasn't going to go our way was the put. Okay. So for the put, we had bought it for $4.40. We could sell it for $1.45. So we did. So that is a loss. Okay. And then we're hoping that the call that we stayed with the trade a little bit longer for would make up the difference in that. Okay. But I showed you the candle, and it rallied and came down. It looked like maybe it was not gonna, it looked like it was fizzling out. And so we went ahead and said, let's just salvage what we can. So we paid on the put, or rather the call. Where did it go? 95. We bought it back, or we sold it for $6.65. So we got a little bit out of it, but not as much as we wanted. Okay, let's fill in the dollars and cents here on our little spreadsheet. So for Marvell, the long straddle cost us, I'm going to put in here 5.55 here. Oops, that's not 5.55. And 4.4 here. And our exit on the 87 put was $1.45. I'm going to put that. We just need the difference there. And same thing here. 555. 145, I apologize. And then on the 95 call, 665. And then over on this side, we want to take the net of those two. And I should have put this one kind of as a little minus here. Okay, one's a plus, one's a minus. We take the net. Well, I did the formula here, so I'm just going to copy it down. And so one, we lost $1.10, which is not so bad. The other one, we gained $2.95, but it was not enough really to cover our expense. Now, to me, that's not looking quite the best, but this summed up to what, $9.95. And so we ended up losing a little bit on this trade. So like I said, we learned lessons. What's interesting to me is it moved what the market makers had priced in. It really made that big gap up. It moved, but it wasn't enough to cover the cost of the premium. It just wasn't, unfortunately for us. So we took a little bit of a hit on that trade. Let me check kind of the questions we've got coming in on the chats. I know Brent's been catching most of those here, but let me see if there's something that I need to catch. John was saying on that, but it was a bearish initial trade. Actually, it's not. Neither of these are initially bearish. They're neutral. We don't know which way the stock's going to move. Might pop, might drop, might sit there, not really even move that much. Okay, so we're not even taking a bias on it. We're saying We're going to position for a big move up or a big move down. And if we get one of them, great. We're going to close out the other as quickly as we can, salvage what we can, with the expectation that if it's a big move, that it'll continue to go that direction. But they're kind of trades that you either need to put in a target exit point for it, which we did on one of ours. Instead, if we get 25%, we'll get out. That's what we did on Oracle. Or we look at it the next morning and continue to play it the next morning, depending on what happened with it. So that's really what we did with both of these trades here. Let's see, the expiration date. Yeah, the expiration date is the same. So as we come back here, we'll go back to Marvell here. So December 19, December 19. Okay, we just did the call here, the put here. It was a strangle. So both of those are a little bit out of the money. That means it costs a little bit less on the trade, but the break-even point spreads out a little bit wider because that strike is out a little bit further, okay, than it is on the straddle when we're doing the same leg, the same month, okay? Let's see here. All right, I think Brent's taking care of most of these other calls. Thank you, Brent. This is a really busy chat session. Okay. Any other questions on either of these two trades? If not, we're going to move on. But I think an important part of this class is really talking about the management, talking about the thought process. What did we do at a certain day because of what, right? I think it's important to talk through all of that. And sometimes it's helpful. I didn't think it was in this day on these two trades, but sometimes we'll go back and look at the 5-day chart and see what the movement was. What time did we get out? What was the stock doing? All right. Well, let's head on. Well, we've got a couple of stocks that are decent movers coming up this week. I'm going to show you the one I didn't choose, and I'm going to show you why I didn't choose it. Okay. We've got a couple of home builders that are announcing this week that have a tendency to sometimes move quite a bit. One was KB Homes, KBH. They announced they've got a decent market maker move here. 7.67% is what the expected move is. And so you can see the lines here. Yeah, what's priced into that straddle is clear up here, almost close to 70 and almost close to 60 right here. So pretty big move, almost $5 on either side, right? $4.98. That's the expectation. So it's like, okay, decent move is expected. When you go to the trade tab, however, you come over here and you see, oh, what's the volume on KBH? Well, today it's only traded 233,000 shares, which is not a ton. They don't have weekly options available. So I looked at this and I said, man, this front month, the December, look at that. Let's look at the disparity here. 91% implied volatility priced into these options that expire this week because of earnings. And then it drops clear down here to 46. So initially you might be thinking, hey, there's some juicy premium in there. Maybe we should go sell something in there, right? And as I opened up the option chain for the December 19s, we could do that. But when I was looking at it earlier today, the spreads were really wide. What's a really wide spread? Well, let's look at this 60 call. 420 by 580. That is what? $1.60. Man, that is a wide spread, $1.60 on a $64 stock. So for that reason alone, just seeing the wide premiums, even though there's plenty of open interest, it was a thumbs down. Okay, it's a no, we're not even going to proceed with caution. It's a we're not even going to touch it, and that's why. Okay, I'm just going to take a quick look at this one. I didn't look at this earlier. I'm just curious if the spreads are really wide here as well on Toll Brothers. Yeah, the spread. Look at this, $1.95 by 285. So it's just kind of when you see that, like a Mack truck come drive through that spread, it makes it really hard for the trader to make a profit. And so that's why you're just kind of hands off, not going to deal with you. Okay. Let's show you what we are going to deal with, though. Let's take a look here at Nike. do Nike first. And it has been a decent mover in the past. I want to show this to you. Let's go out a full year and let's see. When you're trying to determine, is it a good mover over earnings? Does it have a big reaction many times? We look for a couple things. We look for big gaps or, and it could be large candlesticks. Okay. So let's come out here. Last December, they announced on the 19th, which means they traded on the 20th, which is the day I've got my candle on. I'm just going to maybe zoom in here a little bit. Let's get to the 20th. There's the 19th. There's the 20th. Did it gap? No. I mean, it did a little. I mean, it went a teeny gap, right? It went down a little bit. Actually, it started gap down here. I take that back. It gap down to here. Throughout the day, kind of rallied, but you look at it and you're like, it's just kind of a no big move there. Okay. However, the other moves that it has had have been fairly significant. Let's look at this next earnings. Okay. They announced the night of this, and then they opened up the next day. They had gapped clear down, rallied a little bit, but then we're seeing, okay, yeah, there's a decent sized gap there. Zoom into the one in June. That's a very sizable gap here. Look at that move from about 62, closing the day at about 72. So that was a big $10 move. And on a $62 stock, a $10 move is pretty major. All right, let's look at the last earnings that they had. So that was going to be out here in September 30th. That's when they announced. They announced it here the next morning. What did it do? It gapped up. It fell a little bit. It fell a lot bit, and then it rallied back up. Okay, and sometimes we see that. It's not that they just gap and stay. Sometimes they wiggle around. And so, yeah, this one, I'm going to say, generally speaking, has been a mover over earnings. All right. I'm going to reiterate here, the strategies we talk about in this class are speculative. What does that mean? It means it's probably not something you're going to base your trading around. Meaning you're probably not going to go, yeah, let's do straddles and strangles on everything. Let's only play earnings. Probably not going to be that way. It might be one of those strategies that, one, you understand, so when people talk about it, but you might decide, I don't want to participate with these strategies, and that's just fine. Okay. But I think you learn that by doing some paper trading, kind of doing some of this reflexive trading in your paper account and following along with it. Not just throwing it in and forgetting about it, but like, okay, see what the earnings were. What did the market do? Type of thing. Okay. So look what's projected here. Almost an 8% move. We've got pretty decent boundaries here from $62 up to $72 and some change is the expected move on Nike. Let's go to the trade tab. Next step. On the trade tab, was traded over 4 million shares today, so much more liquid of a stock. It, therefore, has some weeklies on it, and weeklies just give you more possibilities, less limitations. It's a lot easier to find strike price and timeframes that you want to work with when those weeklies are out there. Not all stocks have weeklies, like we saw in KBH. There's just not enough trading out there to warrant offering weekly options. All right, but look here, 96% implied volatility priced into these options. And then just a week out, 11 days later, it drops down to 63%. So we're talking 33% implied volatility priced into these Nike options. That's pretty big. That really is pretty big here. We're going to do, well, actually this, let's see. Let me think here. I actually went in the wrong order that I wanted to go. All right, let's just do this one on Nike. Let's open up the December 4s, and we're going to sell the at the money. Now, the at the money's changed a little bit since I looked at it this morning. The at the money now is 68. It was 67 earlier today. but it has these single strike increments, which is fantastic. It makes it really easy for you to get close to what you want to do. So we are going to sell a little bit of that premium. Okay. So we're going to go 68 on the put. I'm going to hit my control key on the keyboard one. At the same time, I'm clicking on this bid price to sell that. And on the 68 call, going to do the same thing. We're going to sell it. Now, is that bullish or bearish? No, it's neither. We're taking a stake on either side, right? Short a call and a put. Typically, short puts are bullish, short calls are bearish. But we don't know which way it's going to go. And actually, do you know what? I clicked on the wrong one. I need this to be 68. All right, there we go. Both of them, I want them to be identical. Not sure why that was kind of highlighted there, but 68 on both sides. All right, we're bringing in a credit here. And notice the credit is similar to, not always exactly, but similar to the market maker move up here, $5.37. That's the expected move for the event. That doesn't mean the total move to options expiration is just for the event. All right. Let's see. Sometimes those weeklies can be less liquid. I appreciate that, Brent. Yeah, sometimes you'll look at the weeklies and sometimes you won't see that much open interest. This one has a ton of open interest, right? We've got thousands of contracts out there. Like you can even look at today's activity. The market is still young in the day, and the volume, now there's been a ton of volume on it here. Now, what if you're like, well, that is a good premium, but what about the risk? What if you're an account and you're like, I cannot buy and don't want to buy 100 shares at Nike at 67, right? Don't type $6,700, right? So it's an expensive stock. I mean, it's not an expensive stock, but it ties up some money if that's the case. And maybe you don't want the obligation to deliver it to somebody else at that 68 strike price, which is what our short call obligates us to do. Then what we could do is we could put on a hedge with it. Okay, so we are going to put on a hedge with it. And what we're going to do is we're going to go out to the next week. Okay, so we're going to collapse this. We're going to come out to December. And December 26th, I should say. So day after Christmas, the market will be open, I believe, the full day. And what we're going to see here is maybe buying a strangle. Okay, maybe going out to next month, let's buy some protection, but let's not pay a lot for it. So instead of doing the out the money 68, we're going to go up a couple of strikes, down a couple of strikes. So on here, since we did the 68 as the out the money, let's do this. We're going to buy the 66 on the put side, and we're going to buy the 70 on the call side. Right here. All right. And then it puts it over here as a custom. Sometimes it'll, we're missing a leg here. What happened? Oh, dread. I must have not hit my control key on one of these. Let's see. We've got the 66 put. Looks like the 70 call didn't go. Let me make sure my control key is down here. There we go. Okay. So our 68 column put, now our 66 put, but this should be long. This one should be long too. Did I hit the wrong column? Okay, there we go. All right, 2 short legs, 68. 2 long legs, a 70 out of the money, a 66 out of the money, and it still leaves us with a little bit of a credit. Now, the question is, well, what's our goal here? Our goal is to try to capture a lot of that implied volatility up front, okay? And so we can do a similar thing. Let's see which day these guys announce. They announce on the 18th, which is, I look at my little calendar, Thursday. So we're going to sit in this trade until Thursday. Implied volatility could creep up. make our short options less valuable. It could also drop a little bit. The idea with this one is let's run it through earnings. Let's see if we can capture that front week of volatility, keep our protection with the long strangle, right? The 70 and the 66. And then we'll kind of see what the news is. You know, if it doesn't make a huge move, might be that we collect a lot of volatility. It might be that we go, great, let's just go sell what we have left, what remains in the long legs that are protection legs. If it goes to one, you know, maybe one side or the other, then we might have a clear winner and a clear loser. Okay. We really all get to find out all together what happens, even though sometimes people are like, oh, these guys are going to have great earnings and they're going to have great numbers. We don't know that. We'd like to think that sometimes, but we really don't know. Okay, so that is the intent. Any questions on this trade? Okay, that's our Nike. Thursday is going to be the big day, so let's hit confirm and send. Let's put this out in our straddles and strangles grouping. Send that off. We're going to track it again. We're going to see what kind of lessons we learn, see what kind of profits we're able to capture, see if it makes the market maker move or doesn't make the market maker move, and then the decisions we make based off that. Now, the other trade we're doing here is Micron. Micron has earnings as well. Let's go over here to the charts. On Micron, semiconductor stock, many times has had big moves, sometimes doesn't have as big of moves, but you know, sometimes it does. So you go back here and you go, well, there was a gap here, right? This is where they closed, and then they gapped down and fell a little bit more on that last earnings in December. This earnings, I'm going to say that's a small gap. I wouldn't say that's a big gap like some of the other stocks we've looked at. Earnings here, I'm going to say that was not a big mover. That probably had implied volatility priced into it, and it came crushing out as soon as the news came out, but it didn't really make that big move. When we're long a straddle or a strangle, we really do want it to make a decent sized move. Last earnings, what did they do? Last earnings, they moved a little bit. Okay. However, this is when they do have a lot of implied volatility priced into it, 8.6%. And this is what is about a $20, almost a $21 move on this stock, on this $241 stock. So what we did, we actually took a position on this on Friday. Why Friday? Why not wait until we had class together? Sometimes people might want to put on a trade a little bit more in advance than just when the week of earnings. I didn't think about it as much, but when I thought about it, I was like, okay, let's go ahead and put it on. So what we did, and let's open this up here. You can see we did the same thing that we did on Nike. Okay, we sold a call at the money that day of 240, and we sold a put, and we brought in some pretty decent premium here. Okay, and then we did the same thing. We went out to the expiration December 26, and we went again out of the money. Okay, $10 out of the money. So we bought a put for protection, $10 out of the money. That's going to be our 231, and then our 250 is on the call side. Again, hoping to capture the implied volatility that's priced into here, giving ourselves a little bit of protection. And this one it called a double diagonal. The other one we put in, I can't remember if it said double diagonal or just custom here. Now, looking at it, and not a lot has changed, right? We're up a whole, okay, 750 now. So the trade really hasn't changed a lot since Friday, but it might before they announce their earnings. Their earnings are due out on the 17th. So that's going to be Wednesday after the market closes. So the first trading day for that is going to be Thursday morning. So I'll be keeping on top of that. Okay. All right. Any questions on these two new trades that are the same? Selling some premium with a straddle, find some protection with a strangle, further dated out. Okay, we're doing that both on Micron and on Nike. All right. I hope you guys are subscribers to our Trader Talks channel. It makes it so much easier to find our content when you do. And so I'm going to pop over here to what it looks like. When you're on our Trader Talks channel, you see our coaching webcast. You see, gee, what's going on today? Well, we're having our class right now, Straddles and Strangles. Barb Armstrong is going to be right up next, right at the top of the hour. She'll be doing trading a smaller account. And then you can see the agenda through the day and kind of get a feel. And maybe there are some of these you're like, oh, I don't want to miss James. Notify me. Let me not forget that James is going to be on. And then we also have playlists for the different classes. You go back to our playlist to see what has happened in the past, see what we talked about, say on the Oracle and Marvell trades, see what our discussion was about now that you've seen the outcome of it. And then we've got some other, like some bite-sized content. These are really short videos. Brent did one that might interest a lot of you here, buying and selling stock on Thinkorswim Web. Some of you use the web version of Thinkorswim. Sometimes you're in a situation you can only have access to a web browser and not the software altogether. Yeah, you might be thinking of using the Thinkorswim Web. So Brent has that good one out there, and Barb did another candlestick pattern of an evening start. So just a little bit of short content. They're usually they can't be more than 10 minutes, okay? And you can see most of these are like 6, 5, so forth. They're really short little videos. All right. So makes it easier to find our content. Now, I did not see a survey out there today, which is good because I think our class has been surveyed quite a bit. And so no survey there today. If you thought that was as helpful, go ahead and hit the like button on the way out. That lets other people know. Hey, if you're interested in this strategy, we've had a really good discussion here today. You might want to pay attention to it. It changes it in the algorithm that YouTube uses, and that helps us promote our channel and our content. Follow Brent and I on our X account, Brent Moore CS, Connie Hill CS. You guys have been great today. I think we've caught up with the questions. I'm going to take a quick look real quick. John Smith, okay, do you have to wait for the expiration of the short trades, or can you exit before? John, you can exit anytime you want, right? On those shorts, you can exit anytime you want. Our example trade of Oracle, one of the legs went out early on us. It did. One of the legs, we said, if I get 25% of it, happy am I, right? Happy are we. And it took it and closed down the trade for us. So you can do it any time you are satisfied. Okay, you can put a number in there like we did. If we got 25%, check us out. Let's just take the money and run, or something you feel more comfortable with. All right. Very good, you guys. Take a quick snack break, pet the dog, stretch a little bit, right? Coming up next, like I said, is going to be Barb Armstrong trading a smaller account right at the top of the hour. I'm going to keep on top of these trades this week and follow up with you. We'll see what lessons we learned from Micron and Nike this week. All right, we'll see you then. Bye-bye.